All right. Good evening, ladies and gents. Let's just go over basic housekeeping rules for those who are not familiar with them. Right. This should take about a minute or so because this time is 6:57. Okay, so the time is 6:57. Today is actually the 31st of December, 2019, and yeah, a few hours from now you're going to be in 2020. So that is this is actually our last session for the year. Okay. Trust everyone has enjoyed most parts, right? So I know probably you wouldn't have enjoyed everything, but most parts of it. And yeah, hopefully it is making sense and sort of like just sinking in. Yeah, back to today's business. Basic housekeeping rules. You'd need to raise your hand, right? Because everyone is going to be on mute, and you actually need to raise your hand in order for you to be noticed, right? So the reason being, I just put everyone on mute because there's a lot of background noises for different people. Some of us are probably in clubs and something like that today and still want to come through to tonight's session. And obviously, that would make a lot of background noise. So, to avoid that, we just mute everyone and then, yeah, you'll be able to raise your hand and then I'll unmute that person. Okay. And they'll be able to ask whatever question and we'll be able to talk a bit and sort of like discuss whatever issue that you might have or question rather. Or alternatively, you can type your question in the chat bar and I'll repeat your question or I'll read it out loud rather, and then I'll proceed to answer it and we sort of like have a conversation around that. Okay. So certainly it's yeah, it's a more of a quieter session today because I'm pretty sure most of the guys are out just to like celebrating with family. And yeah, let's the time now is 6:59. Let's just get started with tonight's session. Okay. So if you guys remember, excuse me, if you guys remember, for the past week or so, we actually discussed candlestick patterns as well as we discussed candlestick patterns as well as the Fibonacci, if I'm not mistaken. Okay, now one of the other elements that we're going to be looking at is moving averages, right? I have an entire video, full-length video with slides that I've done previously, and I will link that into the Telegram channel so you guys can just go over the material and sort of like get the fundamental understanding of it. Because now we're just gonna be using more on a practical approach towards it and actually seeing live examples as I actually explain the main purpose of it. Okay, now with the strategy specifically or with any other methodology that you might be using, it is important to use or be cognizant of the moving averages. Okay, the moving averages are simply sort of like lines that smooth out and average the price. Okay, so if for example you have a 200 moving average, the 200 moving average on the 1 hour, this is on the 1 hour on the USD CHF, it will basically take the last 200 candles on the USD CHF and basically plot out the average price. Okay, so it's going to give you an average price and therefore sort of like the directional bias of generally where the market is heading. Okay, so with that, what you want to do is it helps us rather to determine the directional bias or directional trend, and therefore it helps us to actually form like a solid bias just at a glance instead of us having to go through a lot of the hoops that will be sort of like an obstacle for most guys in the beginning. It helps to clear those up and be able to identify at sort of like on an instant which direction that the market is generally heading in. Okay, so now we use mainly two moving averages, but we do have the 50 moving average as well. We have not included that one in here because I just don't want the chart to be a bit messy, so we'll look at them individually and we'll look rather at the 50 EMA alone. Okay, now there's the simple moving average and the exponential. The exponential is simply weighted a bit differently, so it's much more responsive, it's much more faster than an SMA. I've explained all of that in the session that I previously did, and it's also in the PDF why we use the moving average and how it's actually calculated and all of that stuff. So we're not going to be getting into deep with regards to that. Just refer to the PDF, the ebook, and it should give you like a clearer understanding. So that's what I always say, right? Well, I think sometimes I neglect to say that as we go through these sections, all right, it's important to actually take the PDF and just read through the examples, read through the meanings, and why we use certain things, because sometimes we don't have enough time here in the session to explain that and to also get some live examples. So I just like to be brief in terms of the explanation and then just give some practical examples which will, you know, sort of like help with whatever is in the actual ebook. So um, we are looking at the yellow. Okay, so the yellow is the 200 moving average, and I think this is blue. This is 800. I was struggling between blue and dark blue. Not sure what's up with my eyes, but we can see that the moving average, the blue one, which is the 800 EMA, is actually hovering around above the price. Okay, now generally, if we have the price averaging below the moving or moving below the moving average, that simply indicates to us that we have a downward trend. Okay, now it may be a short-term downtrend or mid-term or even a long-term downtrend, depending on what time frame that we are actually looking at, because right now we are on the 1 hour time frame. So this definitely is sort of like a short-term trend, because these are all single days. All right, so from here to here, this is one day. From there to there, that's a single day. So this is just a few days from the entire month basically. Okay, so the 1st of December, let me just move this. Okay, so the 1st of December is there, or the beginning of December rather. I think it was on the 2nd, first trading day. Boom, you can see that since that crossover around the 2nd of December, the market has moved, or the price has been firmly below that 200 as well as the 800 moving average. So that does suggest to us that we've been heading downward on the USD CHF for the entire month. Okay, now the picture may change if we then move up to one of the higher time frames, let's say your daily or your weekly, okay, as well as your monthly. I'm not sure where to put this, guys. Just I do apologize that I'm shifting it around so much. Okay, so let's just use the weekly. Okay, so if we look at the weekly and we're just focusing on the 200 moving average, we can see that it's been giving us hints that it's in somewhat of an upward trend, and this 200 moving average has been acting as support, right? Break below the 200 moving average and the market shifts away to the upside. I've clearly explained that in the ebook, okay, about how and why this sort of formation happens around the moving average as a form of support and resistance. So it's very important that we take the time to just sort of like understand before we start to actually take trades and decide that this is a positive signal for us to actually buy or to sell, right? Okay. Yes, the meeting has started. It does seem like my mic is actually working pretty well today. Okay. Let me just try. Okay. All right. So if you're having audio issues and you can't hear me clearly, first thing you need to do is just log out and then log back in. If not, just try and use headphones or something like that. And if that doesn't work as well, it's probably going to be an issue of network on your side, because on my side I can see that the mic is working perfectly well. So you can just stick around, right? Catch parts here and there, but the session is being recorded, therefore you don't need to worry that much. You can just watch the recording after the session. Okay. Right. So this 200 moving average acts as a support, and we've seen that the market has been in somewhat of an upward trend, right? So that is another application in which we can use the moving averages. The first one is obviously to determine trend, and the second one to use it as a support as well as resistance level in order for us to actually get like a clear indication of where the trap volume actually is. Okay, because there's a reason why this usually happens, right? There will be sell orders just below this moving average here, and as it moves lower, right, it's gonna activate and validate a lot of trading systems that will decide to go short around this area, and that's going to create a lot of volume, and there's going to be a lot of buying and a lot of selling as well around this area, which is obviously those liquidity areas we'd like to see. Now, in this instance, okay, this is not the best example because we can see that the moving average on the 200, right? The 200 is still firmly above on the weekly. So on the monthly, okay, on the monthly moving average is above. On the weekly, it's above. On the daily, it's sort of like in the middle, which I'll explain a bit later on towards the end of the session. And we have the H1, which is above as well. So we also have this cross right there. Boom, which does tell somewhat of a story in terms of momentum shift. And it's always important to take note of what the higher time frames are actually doing. Okay. Now, I've also done plenty of videos regarding which time frame to actually use in terms of trading, whether you scalping short term, you are swing trading, which is a few days, your positions are a few days, or you position trading, you few weeks to a few months to a few years, and depending on your time horizon, then you'll use the appropriate time period or time frame. So just by looking at these time frames, we like to use at least about three. Right, we don't want to analyze on each and every single time frame because that is definitely going to confuse you, and you will literally die of the fear analysis paralysis, basically. So you'll just sit there and just do analysis for 24 hours on one market and just not be able to trade anything. So rather stick to that three. Like I said, you can watch the previous sessions to decide which ones you're going to be using based off what sort of trading approach that you're going to have, whether it's short term, swing trading, or position trading. Now, we can see the bounce, boom, and a lot of rejection after this cross of the 50 and the 200 moving average. And as I said, that tells us a story about what was happening around that area at that particular point in time. Okay. And usually when this sort of like occurs, there is a shift in momentum away from that moving average. Okay. Now, a lot of the times you might see the market repeat above that EMA, right? You get like numerous hits just above that moving average, whether it's the 200 or the 800 moving average. And from there, you just um, become uncertain due to the fact that it just keeps repeating. So what I say is usually just go for that one hit, right? So once you get that one hit, that's a bit more, I can say, reliable rather than having the market close above and then giving candles like this. All right, let me just remove this. Trust you can hear now. Hopefully you can hear now. Okay, let me just zoom in. Okay, so this would be a better hit than this one. You don't want the market to close above and give you 1, 2, 3 candles above that moving average, because that suggests that it has been broken, and you don't want that moving average to be broken, and the market to close above it and give you numerous candles above it, because that's not really what this is all about. You want to see a clean rejection, okay, from that particular area. A clean rejection like this, boom, one candle, right, pin bar probably, and you get that sort of momentum shift to the downside. Okay, does this make sense? Okay, so now let's move up to the H4. Right now we can see on the H4 that we've had right, this is 1 week. Okay, this is 1 week. So from there to there, that's a week. From there to there, that's 1 week. From there to there, that's a week. And then from there to there, that's a week. So this is, we actually in the 5th week since the beginning of December, and since this downward break and this retest and shift away from that zone. Now, if you're familiar with just basic support and resistance, which at this point I do hope you are, we can see something familiar that we usually see in support and resistance levels that would have given us an opportunity to actually just get into the market. So it would be like you're using support and resistance. So that's also just in the ebook, and it's explained quite clearly. I do believe everyone should have it by now. And this support and resistance way of looking at moving averages can be very profitable. As you can see that a lot of the times when the market breaks, okay, a key level, it comes in to retest it, because the market always just looks for liquidity. Okay, that's basically the one thing that the market will always continue to do. Right, it's just going where the money is. So the most important thing that you want to be able to identify when it just comes to identifying market structure is where the potential money actually is lying. So I think once you get the hang of that, right, and once you firmly understand that at the end of the day, if you can find using these tools, because it's not going to be just one tool. You're not going to look at the moving average and get a bounce and be like, okay, that's it, now I'm getting into the market. There's a few things that need to come together at that particular area, and once you become familiar with it, it's going to be like they come together so many times, and you get so many opportunities. You might not get an opportunity to actually get into the market every single day, but if you do get, let's say you miss 1, 2, or 3 days without any trades or any setups, I mean, Wednesday might be Thursday, Wednesday, Friday, you might get like an abundance of positions. So I would think that the most important thing that we want to take a look at is just being able to identify where the money is. And this is one of the key things, or one of the key hints that we need to be cognizant of or aware of in order for us to be able to make firm and confident trading decisions, because that's what this is all about. So in this example then, since we've identified that this is our 200 moving average and this is our 800 moving average, one of the questions that I've usually get is which one will take preference over the other. Okay, I mean, for me, it doesn't really matter. Either or works. Okay, and if you get a tag, or if the market moves up, for example, and gives a rejection candle, now remember you need to align with your candlestick patterns, and gives a rejection candle right on the 200 moving average, it doesn't have to come all the way up to the 800 moving average. Okay, but you just need to get somewhat of a retracement back into the zone, preferably to the 200 moving average or even the 800 moving average, and then the market shifts. Okay. Okay, so what you want to do then is sort of like have these ideas in your mind before they actually happen occur in the market. Okay, last week we went through the fib, right? And if let's say we were expecting the swing high, right? The swing high and the swing low, and we get our 50. Okay, if this part is not making any sense, then you can just watch the previous video. I think it's last week's video, yeah, last week, Thursday or something. So swing high, swing low, and we identify our 50 to 62% range. And what we do then from this point is sort of like identify and be like, okay, if the market comes in here, right, to this zone, gives us a rejection candle, then we'd expect the market to fall, right? So it actually helps us to anticipate and get a really rough idea of how we'd like to trade even before the market actually gets there. So once price gets to 0.9850, we already know what we're going to do. And if we get the sort of candlestick pattern that we're actually hoping for at that level, then we already know what we're going to do. And if we don't get it, right, like we didn't get it in this particular example, then we actually stay out the market, right? We're not forced to get into the market. There's a lot of opportunities elsewhere, right? Trust me, every time you miss one opportunity, there's probably like two more opportunities that are occurring somewhere else. So you don't need to actually worry yourself too much about that. Just make sure that you just stick to the game plan and ensure that each and every single position that you actually take as close as humanly possible, close to the predefined setups that you'd actually like to see. Okay. All right. So now let's get rid of the fib. Okay. Don't think that's the correct way to get it out there. All right. So now, as I was saying then, in this instance, that 200 moving average would have formed somewhat of a resistance level, okay? And we have another resistance level at that 800 moving average, okay? Now this one would have been much more solid because it also has a previous zone to it, and I do believe that there's a round number somewhere there as well, which I don't think we've gotten into just as yet. Okay, which is 98.50. So I mean, this was definitely something worth taking a look at least if the market did come up to that level. Okay, certainly worth us taking a look at if it did happen like that. Okay, now one of the key things that you're going to do when it comes to the moving average, right? I did say we're going to discuss it towards the end of the session, is this. Okay, now, when we start to see this, right, the 200 crossing the 800 and then up, and then it crosses down, crosses up again, crosses down, crosses up again, that gives us an indication that the market is in sideways consolidation. Remember, if the price is above the moving average, as in, okay, all right, so let's just say the price is below the moving average as it is with this 800 moving average, then the trend is down, okay, and if just can't find another one. Let me just change this one to, I don't know, 800. Okay, let's make this yellow. Okay, let's just use something smaller just for the sake of the example. So if the market is firmly above the moving average itself, then we know we have a upward trend. Right, downward trend is when the moving average is firmly above the price, and the more it actually fans out, the further it gets, the stronger the actual trend is. Right, so just always be aware of that fact. Now we have the crossover. Okay, crossover is just indicative of a shift in momentum. So if the trend was going upwards, right, even if it was just an accelerated move or sort of like a flash move to the upside, as soon as we get the cross to the downside, it indicates a shift in momentum towards the opposite direction. So it's always a key indicator in giving us sort of like that directional bias. It helps us to form a directional bias by giving us that cross and indicating to us that the market is sort of like ready to shift to the downside, for example. Okay. So if you are looking at, let's say, boom, right, at this now, you don't necessarily want to be caught up in moves where the moving average is moving sideways like this, because if you trade in line with just the bounce of the moving average, then you are almost certainly, right, if you couple that with the Fibonacci retracement tool, you are almost certainly always trading in line with the major trend. Okay, so that is something that you're always going to be doing, which is going in line with whatever the major trend is. So you won't be trading against the trend if you focus on the moving average as well as the trend, rather the Fibonacci. Okay. All right, guys. So for further study on whatever you're not sort of like clear on, or you just need some background information regarding the moving average, just go through to the ebook, right? 3 powerful strategies, and go through to strategy 1, and you should have sort of like an index about where the moving average section actually is. So I've detailed everything that you need to know regarding why we use the moving average in the strategy that we actually use, and how you can apply it in any sort of strategy that you are currently using, just to help you sort of like filter out a lot of the noise that you might be getting with the trading signals that you get. Okay. So, all right, guys. So I'll be taking questions now. So if you have any questions, you can just shoot. You can type it through in the chat, or just raise your hand, and then I'll unmute your mic, and you'll be able to talk. But if there are no questions, I'll end off the session right here. Okay. Now, as I said, this is definitely the last session for the year. Trust everyone had a fantastic year. Yeah, I wish everyone a very prosperous 2020. Okay. I think one of the most important things that we just need to focus on is sort of like improvement. Okay. I mean, nothing can beat like continuous, no matter how small it is, consistent improvement. It's one of the things that I learned in this very awesome book. Forgot the title now, but the term is Kaizen, Japanese Kaizen, just continuous small incremental improvement where you do things a bit better than you did them yesterday. So I think for everyone, 2020 should be focused on just small incremental improvement, because a lot of guys just try to leapfrog into getting these big numbers or these major successes, but just do things small, right? We have major galactic goals and stuff like that, but always try to pursue them with the mindset of breaking things down into smaller increments and just persistently doing the things that, well, most other people won't be doing, like being here on New Year's Eve and stuff like that, which obviously large majority of guys, judging by the turnout as well, aren't willing to do. So I mean, that's certainly the best you can do, right? Is continuously just seek to improve and do things better than you actually did them. When you look up, you'll definitely be where you want to be, or very, very close to where you actually want to be. And it's going to be like, I mean, there's a line where you just cross when it actually comes to trading. I do believe with everything else, where you sort of like struggle, and then you sort of like cross that line. You don't even know that you cross. You don't realize rather that you crossed that line, and things just become very easy. It becomes easy when people watch you do stuff. They feel like it's so easy for you. You're talented and stuff, but they don't realize that there's a lot of previous work that you actually had to put in order for you to actually get the results that you are getting now. So, I mean, for me, that would be the only message, right? Just do your best on a day-to-day basis. Just focus on the next day, right? Focused on the next day. If it's Monday, you're like, okay, let me hit my best today, right? And if it's Tuesday, just continually do that, right? Pat yourself on the back, and surely, but slowly but surely, you're definitely gonna get where you need to be, right? So I don't see any questions. So if there are none whatsoever, I'll be ending off the session today, right, guys? Hope you guys stay safe tonight, and I will see the beginners tomorrow, right? Tomorrow, same time, 7 p.m. for our normal beginner session, and our last advanced session for the week will be on Thursday. So look out for that. I do believe that I might be doing that a bit later than usual, probably around 7:38 p.m. But I'll let everyone know in the Telegram channel. Right. So guys, enjoy the rest of your evening, and I will see you guys next year. Cheers.